Good morning, students. So today we will be discussing startup finance and value at risk. So let's start with the startup finance. So students, for startup finance, first of all, we need to understand that what is exactly called as a startup. Then only we can study that what are the different type of financing techniques for that startup. So if we see a startup is actually defined as there are some conditions which has to be fulfilled first, then only any entity can be regarded as a can be called as a startup. What are those conditions? Now the first condition is that the startup would be there for the initial 10 years. Let's say today the company is getting incorporated, or there is a LLP getting incorporated. So from today till 10 years from now will be the time period under which it will be regarded as a startup. So up to 10 years, from the date of incorporation. This is the first and foremost condition. For example, if a company is there which is 15 years old, that will not be considered as a startup because already that company has spent a reasonable amount of time in that particular industry. Similarly, if it is for 11 years also, it will not be regarded as a startup. So startup is something which is up to 10 years from the date of incorporation. During that time period, that company or entity, whatever it is, will be regarded as a startup. Now, what is the legal form of this startup? Not all the type of companies comes under startup. Now, if you imagine there is a public limited company which has already raised an IPO, which is listed after doing the book building process, IPO, then its shares got listed. So do you really think that, and it is still in the first 10 years of its operation, it's still here in the first 10 years of its incorporation, then do you still feel that is it a startup? No, right? Because it is already a big company incorporated as a public company which has raised a lot of funds from the public at large. That means it is not a startup. Correct. For startup to initiate, it should be starting from a smaller scale with a smaller capital, smaller turnover. So hence we say that the legal form can take place for a startup company to be, let's say if it is a private limited company, if it is a private limited company, then only it will be regarded as a startup. Or if it is a registered partnership firm, there is a partnership firm, let's say there are two, three co-founders, they have gone into a partnership firm and they get it registered. That is also okay because generally partnership firms don't operate on a very high level, and similarly private limited companies as well. And the third form is actually a partnership only, but a limited liability partnership, LLP. This also needs to be incorporated and registered before it can come into existence. So these are the three valid legal forms of a startup that is given. Okay. So first of all, the startup should be in the first 10 years of incorporation. The company or the entity should be in first 10 years of incorporation. The legal form of the entity should be either it should be a private limited company or it should be a registered partnership, or lastly it should be a LLP, which is again registered only. Correct. Now what is the third condition? Now the third condition is, let's say the business, for example, satisfies A and B both the conditions. For example, any startup satisfies A and B both the conditions. Now, and they are, let's say, a private limited company, they are into the first 10 years of their incorporation. But what they do is their business model is such that they have far exceeded their turnover. Okay. I mean, they are a 1,000 crore rupees turnover company. That means, do you really think, say, if they're making 1,000 rupees, 1,000 crore turnover, so are they still operating on a smaller scale, or are they still operating as a startup? No. Now the proper growth has come. They are able to make a lot of money. Their turnover is good. Their P&L would be healthy. So hence the third condition restricts the turnover up to 100 crores. Turnover should not exceed rupees 100 crore in any financial year. If this is exceeded, then you are coming out as startup. Then you are an established company. You are not a startup. Correct? So if it is up to 100 crore in any financial year, then only you will be treated as a startup. Now, combining all these three conditions, up to 10 years from date of incorporation. Second is their legal form can be anything. Only these three things that are listed, and their turnover should be up to 100 crores. It should not be more than 100 crores. These all three conditions says that it's already a basically the smaller size company. Correct? Now the fourth part is, now what if you talk about a group, let's say a very big group, for example a business group. Correct? For example, Reliance, for that matter. Now if they have started a new business, correct, so what they can do is they can easily do a demerger, create a new company in, let's say, private limited company form. It is first 10 years of their incorporation, and since it is a new business, the turnover they likely estimate is about, let's say, 100 crore, up to 100 crore. So what will happen essentially is that in that case also, there is an established group which has done a demerger or done a hive off, and they have basically created a new company, which will again mislead the rules. Why? Because ideally this is not a new venture that is coming out, right? It is only because of a reconstruction of a business which is already there. So even in that case also, it will not be regarded as a startup. For startup to be there, it should not be because of any, the resultant entity of startup should not be because of reconstruction of a business already in existence. Okay. Now, so basically, it should not be because of any reconstruction in the existing business. If that is the case, then everyone, what they will do is they will start forming multiple companies of the existing business. Correct? Even large business houses, they will also start forming smaller companies, because if you are registered as a startup, if you qualify for startup, there are a lot of incentives that the government gives. Correct? In terms of financing, in terms of taxation benefits, in terms of a lot of things. So in that case, all the business houses will do this. But to avoid this kind of a thing, it is clearly mentioned that it should not be because of any reconstruction of a business already in existence. There should be something new that should come out from the entire proposition, from the entire venture of this. And the last part. Now, the last and foremost, the last part is very logical. So what does it say? Now, for example, I start a limited liability partnership, for example. Okay, and I have started just now, so I am satisfying condition A, B, and my turnover is also, let's say, 50 crore. Correct? Not 100 crore, it is 50 crore only as of now in the first year. And it is not because of a reconstruction. I have started a new business of my own, which don't have any links to any other business that already have an existence. But through that business, I'm just doing a normal trading. Okay, I'm just purchasing the food grains and I'm selling it. That's all. Correct. And that I'm doing under the limited liability partnership. So do you all of you feel that whether business that I have just now started should be a startup? In layman terms, yes, it is a startup, but what value added things it is doing to the either the business I am doing, or to the market I am serving, or to the consumers I am giving it, or from the suppliers I am taking it, or is there any new technology that I am using it? So hence, to go for the proper value addition, by value addition I mean proper improvement in the way the business is done, that is the last condition. Because the conventional methods, the old methods, which let's say I'm just taking order on phone and I'm passing on the order to my suppliers on phone, simple, that is not a startup. That can satisfy A, B, C, D, but that will not satisfy condition number E. So condition number E says that there has to be an innovation, there has to be a development of new product, or there has to be a development of any new process or service, and that all should be driven by a technology or some kind of an intellectual property. So they are saying that your focus should be that you should do a proper research and development R&D, and hence you should innovate, or you should be able to develop a new product which is not in existence. So innovation means existing product with some new features, right? But with some new things, and any process or service which is, and all these things should be because of the technology, correct? Because of some technology which is not already there, or intellectual property which has been designed specifically for the business. Innovation, development of new product, or it is, let's say, process or services which should be driven by technology. We should use technology. We should use technology for carrying out each and every step of the business, correct? Or some kind of an intellectual property. Doing the things in the old manner will not help. That will not be regarded as a startup. Doing the things in an innovative way, in a new way, which are not established, using technology intensive techniques, or developing some kind of an intellectual property, okay, that will really help, and that those entities or those particular companies would be regarded as the startup entities. I hope the definition is clear. Once these A, B, C, D, and E conditions are satisfied, then only we say that these are the startup companies. And once it is qualifying as a startup company, then it can easily avail the government services. Okay, and this definition is actually given by the government of India through a notification. Okay, so hence these are basically the 5 different types of conditions that are there. So basically, entity, in the last point, it says that entity should work towards the innovation, development, or improvement of the products or processes, correct? And it should have a higher potential of employment generation or wealth generation. It should lead to the newer improvements in the existing business or in the existing product where it is set it out. Okay, so this is done. Now, coming to the main part. So till now we have studied that what are the different conditions using which we can say that a particular entity is a startup or not. If it is a startup, then it it is okay for that company to avail the government schemes. By government schemes, they have a lot of incentivization schemes, taxation schemes, all those things. Now, coming to the financing part. Now, students, if you see, all these are basically smaller companies, correct? They don't have very big capital. They don't have really very big sources of funds. So And but they, on the other hand, to do this technology intensive tasks or to develop a intellectual property, they need a lot of investment. Correct? They would need a lot of investment. Why? Because without those investments, they will not be able to carry out their R&D thing. Okay. So hence they need a lot of money, and hence there is a need for us to understand that what are the modes of finance available for a startup. What can be different types of modes that are available for a startup? Sairam is asking, its company should satisfy all the all conditions. Yes, Sairam, the company should satisfy all these conditions, okay, to form a, to make sure that this company can be called as a startup. Don't use the word company, because we have company, we have partnership firms, and we have LLPs as well. So hence, better to use, let's say, startup only. So the startup will be in such legal form with all the 5 conditions fulfilled, then only it will be said as a startup. Okay. Now, because there is a, because there are varied opinions. Let's say somebody might say that why 10 years, only 5 years, why 100 crore, it should be in the Indian context, it should be 500 crores, correct? But government have come up with these numbers to avoid any type of a confusion, so that there is no confusion at all in the overall numbers. Okay, and there is a consistency across the way every business is analyzed as a startup. Now, the first term that we use is called as bootstrapping. Now, students, please understand what does this term is called. There is double P in this. Now, bootstrapping means that broadly we can say there are two things in this. Okay, one is personal finance, and second one is through the operating cycle of business. For example, vendors slash debtors. Okay, so basically, when we call that we are doing a bootstrapping for a startup, in these two conditions, one is that if someone helps with the personal finance, if let's say the founder of the startup itself brings some personal finance, his or her personal savings into the business, that is called as bootstrapping. Correct? Similarly, if we go and discuss with our debtors or with our vendors, for example, there is a new startup, it will go and discuss with their suppliers that can you give me this much amount of goods in a credit form for a 90 days credit, 60 days credit. I will pay you once I am able to realize the money. That is called as operating cycle of business, and that is this form of a finance is called as a bootstrapping. Correct? Now, we will, so these are the two broad categories. One is personal finance and second one is the operating cycle of the business. Now we will see the specific ones. So the first type of finance in bootstrapping is trade credit. Now students, imagine that there is a newly formed startup. Okay, this is a newly formed startup, and in the startup they have devised one product which is not actually existing. That's a new product, and for completing that new product, okay, there is a vendor that they have. This is a startup, this is a vendor. They need some raw materials from this particular vendor to complete that product, okay, that they have already analyzed, and this is the vendor who is available, who is supplying those raw materials currently in the market. Now, what does trade credit means is, so trade credit is simply this vendor says that I always operate on advance basis. You give me money first and then I will give you the goods. But since these guys are startups, I mean, these people are working in the startup, so they will approach the vendor and say that, okay, We have just now started. This is our first purchase order that we are giving to you, and we are actually short of funds because we have just now started on a very smaller scale, and we need a lot of investment to be done. So hence our cash flow position is not that great. We request you to please give us, let's say, 60 days of credit or 90 days of credit. So what they will do is within, let's say, next 20 days, they will finish the product, then they will sell it around, let's say, 20 to 30 days, correct? And then they will realize the realization they will pay to the vendor. That is called as trade credit. So trade credit is basically asking the vendor to give some sort of a credit days, correct? So basically it is asking for credit from vendors. Okay, simply based on the relationship we have to develop, or it may be because of the actual situation that is there. So that is the first part, the trade credit. Second part is factoring. I think factoring also all of you would be knowing because this is a very common term. So what happens in factoring is, now again there is a startup S. Now this has to do with a debtor. So as I said now, that bootstrapping is actually arranging for the finance through the operating cycle itself. Operating cycle means the working capital cycle of the business through vendors and debtors. So through vendors, we have done trade credit. Now comes debtors. So what will happen for factoring is, now let's say the startup has sold the goods to a debtor called D. Okay, and similarly, the startup has also asked for credit from their its own vendor. The debtor is also asking for credit from the startup. Let's say it is asking for 30 days of credit. So he says that after 30 days, I will pay you the amount of whatever the goods that you will give me today. Startup says that, okay, because this is my first order, I have to grab it anyhow. So I am okay to give you a credit. But now what will happen? Startup will need the funds immediately because it cannot block the working capital for 30 days. So startup will approach to a third party, let's say a bank or any financial institution which is engaged in the factoring. So what this factoring means is, in factoring, they will take this amount. Let's say the amount receivable is 1 lakh rupees, correct? Rupees 1 lakh. So they will, what they will do is, in case of factoring, they will give the amount to S today, whatever is the receivable amount, and then they will recover after 30 days from D. Simple. So they will pay today and they will recover from D after 30 days. Now, in this, they will not pay entire 1 lakh. They will pay, let's say, 98,000 because 2,000 they will put for their own commission. So that 2,000 rupees loss, or let's say interest cost, or let's say factoring cost, is borne by S. That is one. Second is, there are also these kind of products available in the market where the factoring will pay 1 lakh here, but the debtor here will pay 1 lakh 2,000 to the factoring agency after 1 year, after 30 days. Okay, so it can happen depending on the mutual understanding or the mutual consent between all of these three parties. So this is called as factoring, correct? And this, I think all of you must be knowing that this is on a recourse basis and a non-recourse basis. Recourse basis means that if debtor is not able to pay to the bank, then bank have the right to recover it from the startup again. And non-recourse basis means there is no, basically in case of a default from the debtors, bank cannot go and ask the money from the startup. So there is no recourse basically. Correct. Recourse means that there is a recourse available for the bank to go and claim it. Correct. So this is factoring. Then the next part is leasing. Now, students, what happens is generally startups are those which don't have a good capital base initially. They don't have a very high scale of business. So they even cannot invest in a lot of assets as well. Now, for example, they need fixtures and furnitures. They need property, plant and equipments. They need computers to run the technology. Correct. All these three things they need. For example, any startup. Now, what will happen is, since they don't have enough money to purchase and do a capex here, correct? For doing the capex, they need to have that hard cash with them, which they don't have. So what will happen? What will happen? Instead of going and purchasing it, they can find some companies who are currently giving them on lease, and they can take it on lease. For example, instead of purchasing anything at 1 lakh rupees, okay, they can actually get it on a lease at 1,000 rupees. Okay, students. So if they are getting it at 1,000 rupees, that means they are avoiding the cash outflow at 1 lakh rupees, which is the current capex. And hence they don't need anything on 1 lakh. They will just do the 1,000 rupees per month payment for taking these on leases. So this is also a good way to finance your requirements on the fixed assets. Correct. So a lot of startups will go for a leasing option rather than purchasing it. So these are the three things. So bootstrapping means that, so basically we are trying to scratch it out, whatever is available in the operating cycle or within the personal financing of the startup. So operating cycle means this vendors, debtors, and even on the leasing side. Okay, whatever is possible, they will just take that amount. They will take that thing and they will move it forward. Okay. Yeah. Now coming to the second part, after bootstrapping, there is a second mode of finance that is called as angel investors. Now, who are these angel investors? As the name suggests, angel means someone who rescues, correct? So let's say there is a startup. So this startup is in actual need of money, correct? Because it has to invest again in the technology, in the initial building blocks of the business, a lot of things. So what will happen is, this startup will have some kind of a contact, correct? So let's say this have contacts with the relatives or with some high net worth individuals as well, who are HNIs, correct? So what will happen is, those people, or let's say those relatives which have a lot of savings of their own, and they're willing to give money for the startup to start their activities for the initial starting phase, those people are called as angel investors. So basically these are the people from known contacts. These are people from the known contacts for the startup entity, and they give their own money to the startup, and they give their own savings to the startup, but they give for the initial requirement, for the very initial requirement, they will give this to them and tell them that, okay, you start the business, we will see on returns later on. If there is a return, you give us the return. If there is no return, then we are okay, because these are known contacts, correct? So there is no clear cut expectation from their side on returns. They will not expect you, because the idea, the purpose from their end is to help you to start the business, not for them to earn the returns. That's why they are called as angel, because angel, they are rescuing, correct, without any further expectation, correct? Yeah. Now the next part is the venture capital fund. This is the main part. I will use the next page actually, because this will take up the entire this thing. So students, now please understand this very carefully, as this is something new, because you might already be having you might be already knowing on, let's say, bootstrapping, which is the operating cycle, and even on the angel investors, but this is a somewhat technical thing, so I want all of you to please pay attention now. So what is a venture capital? Now venture capital is again a commercialized form of giving a loan to a startup, or let's say giving a funding to a startup. We cannot call it as a loan, as a funding. Okay, now it is one form of private equity, one form of private equity. So don't get confused. What is private equity? See, there are two things, right? One is the public equity and one is the private equity. In public equity, there is a IPO, there is a prospectus that is filed, then public at large invests, correct, through a book building process. Then after book building happens, the shares are issued and listing happens. This is called as public equity process. Simple, correct? But in case of a private equity, the public at large is not involved. Only a few group of people are involved, or it can be a one person also. Private equity means only one person with the sole objective that today what is the investment that they are doing and tomorrow what they expect out of the company as a return. Correct? So there is no public at large, but there are only, it is a closely held group of people or even a single individual also. That is called as private equity. Once they give the equity, once they invest, that is called as private equity. So in a layman term, again, I'm saying, so this is the difference between public and private equity. Now we are saying that venture capital is one form of a private equity. So what will happen? Now, imagine some of the group of people who have, or let's say some of the group of the institutions who are having a surplus cash to invest. Okay, if they have a surplus cash to invest, for example, pension funds. If there are pension funds, they will collect the pension contributions from the employers and the employees. They will be having a lot of cash to invest somewhere. They're having a surplus cash. B, if you talk about banks slash financial institutions, C, high net worth individuals. High net worth individuals, HNIs. Or there can be other corporations also, correct? So anyone which is having a good amount of cash to invest, they will come all together and they all will create a pool of money through whatever form they want to put. Correct? So let's say this pool of money is created by the contributions from all of them. And so basically these are funds. These are funds. These are amounts that are there. Correct? And this pool of money will invest in startups. Equity in startups invested through this pool of money. So through this pool of money, the investment will happen in the startups. Now, before doing the investment, deal finalization, a lot of things will go. They will analyze the startup. They will see that what is the future possibility that startup will make up money, or how good they are able to give back the money. Correct. So all those things will be analyzed, which we will discuss further. But for this particular type of a model, a lot of these institutions will come together, pool their money, and then they will invest as the equity in the startups. Now, with what objective? What is the objective? See, students, we have studied that the objective of angel investors is not to mint the money. They just want the startup to initially start. That's all. That is where angel investors are giving the money. Although they might expect that once the business flourishes, they will get their money back along with a handsome return. But the purpose or the objective of angel investors is totally different from the venture capitalists. So venture capitalists are those people who are part of this venture capital. Okay, let me explain what is their objective. Yeah, sorry. So they have three life cycles. One is, first of all, buy. So in case of buying, that means in case of investing in a equity of the startup, or let's say giving a equity to the startup, they will identify the deal. Then they will evaluate the deal. Identify deal. Deal means that which startup to invest. So startups will go generally and pitch it in terms of the presentation. Correct, that this is their idea, this is the new thing that they are going to do, this much is the market capitalization, this is how they are going to do the commercialization and realize some amount, or this is the problem statement that they are going to solve. So they will identify the deal, the right kind of a startup company to invest, then they will evaluate the deal, and then they will execute the deal. Correct, these three steps are involved in buying process. Okay, so evaluation means they will see that whether it is really worth to invest in that business, whether it is going to give some good returns in future, or what is the possibility that the company will do good in the coming future. What is the prospect around the business model that these guys are suggesting, or the product which it is solving. Okay, and execute the deal means finally the giving the money and giving the funding. So this is first. Second is grow. Now, the second objective of these venture capitalists is that they want the business to grow. They want the startup to grow. Now, this thing, they will also contribute through their expertise. They will come to the board of directors of the startup company. They will, so their job does not end by just giving the money and letting them do what they want to do. It also means that they will be part of the regular decision making process. They will influence a lot of decisions within the board of directors by sitting as one of the key positions within the board of directors, because they have invested in the equity of that startup. So they will come from an expertise background. So they will be the people who are already having experience in these kind of businesses or in these kind of things. So in growing, so take decision making, or simply I'm putting decision making, and this will essentially mean for them that making deals successful. Actually, they would want the deal to be successful. And how they can do it? By ensuring that they are increasing the current value addition. So they are keep on adding the new things. But I mean the new improvements, so that the value addition happens. So this is the grow, buy, grow, and the third part is exit, which is sell. So they are not doing all these things for a charity, right? They are not going to do the buying and growing of the startup for a charity. They will have to eventually realize the gains that they are able to make out of the entire deal. That will happen at the right point of time when they are going to sell off their proportion of share in the startup, which is called as, this is called as harvesting. Correct, harvesting the profits. Simple. So they will sell off their proportion, or let's say the percentage of proportion, to some other company, and they will realize the amount. Okay, so basically, let's say they buy today, they will take 5 to 10 years to grow, and after, let's say, 5 to 10 years, whenever they want to exit as per the plan, then they will exit. So this is after 5 to 10 years, they will exit and they will realize the gains to them. Now, if we see, students, the life cycle of a VC fund, venture capital fund, what are those? So the first and the foremost process is the fundraising. Venture capitalists are also raising the funds, correct? Because they have to create the pool of money first. For doing that, they will contact all these institutions, correct? So the first and the foremost step is fundraising. Second is investment phase, in which they will analyze, evaluate, and execute the deal, which is the buy process. Correct. They will do the investment. Third is holding period. Now they will hold their investments, assuming that for 5 to 10 years, they will reap some valuation improvements, some kind of a growth over the existing amounts. And the last part is exiting investment. Okay, students. So while they will exit, they will realize their own gains. And what they look for, VC is looking for one, high growth technologies. See, now there are some technologies which are actually very good, which are very innovative, but they don't have any potential for growth. Correct, because those solutions that technology offers is generally not required as a utility. Correct. So VC will always look for that which kind of a technology is a high growth technology. Second, media. So there is a proper brand building that is happening. So there is a proper information that is going through the proper channels of media. And the last is, it is a consumer driven company. Consumer driven means that always the solutions that the company creates or the startup creates should be coming up, taking into the mind that what a consumer needs. Correct? What are the needs of that consumer and how it is operating. So in response to those questions, to these consumer driven, so basically let's say consumer have a problem statement. Now startup technology is trying to give a solution for that problem statement. So if that is the case, that VC will be very happy to invest in that kind of a company where all the solutions are consumer driven. Correct. So consumer is their core heart of the technology solutions. Now let me take the venture capital again, in detail. Yeah. Okay, now let us introduce some of the technical terms and try to understand what does this mean. So students, let's start. There is a, let's say, private equity group. Private equity firm. Now students, what are these private equity firms? Private equity firms means those firms, let's say some kind of a smallly held partnership firms, which are again in which a lot of high net worth individuals are partners, or a lot of entrepreneurs are partners who have the objective of looking or investing as private equity. Correct, not as public equity but as private equity. They want to invest in a privately held company, not in a public limited company. Okay, so they come with that objective. So there is a private equity firm who have these objectives. Okay, now what they do is they want to start a venture capital. As I told you, venture capital is also one form of the private equity. It is stemming from private equity. Correct. So what they will do is they will look for these pension funds, banks, financial institutions, other HNIs, or any corporations. Correct. So these all people are called as limited partners. Limited partners. These are called as LPs, limited partners. Because why limited partners? Because their liability is limited to the extent of the contribution that they have done. Very similar to the equity shareholders. Correct. The equity shareholders in a company, in a limited company, have the liability limited to the extent of amount that they have paid. Correct. So basically, if the company goes on default, they are not liable to pay anything over and above the value that they have already contributed. Only to the extent of value that they have contributed is what they are going to be liable for. Correct. That is what is the limited liability is, and hence these are called as limited partners. They will actually create this pool of funds. Correct. This is called as a SPV, special purpose vehicle. Special purpose vehicle, which is actually formed in the form of a trust or in a form of a limited liability partnership, which is entrusted with the funds that are contributed by the limited partners. And this private equity firm will appoint some of their general partners. These are called as general partners. These are again some individuals who are entrusted with the task of collecting this money and taking decision on the investments for this money. And these general partners holds fiduciary relationship with limited partners. So basically, they are having fiduciary relationship with the limited partners. What is a fiduciary relationship? So fiduciary relationship means that they are going to handle their investments. Okay. So they are responsible for the security of their investment, for ensuring that the investment is not going down. They will have to carefully analyze, assess all the things in the overall scheme of this arrangement. So these people are called as general partners. These general partners will be appointed from the private equity firm to manage this SPV. And they will also bring, let's say, some kind of a contribution. So for example, SPV is total 100 is having the funds of 100%. Out of that, let's say 2% will be contributed by general partners and 98% will be contributed by the limited partners. Why they're contributing 2%? Because that will bring a sense of ownership to them. Correct. That will bring a sense of ownership to them, that their money is also invested. Hence, they cannot be careless in investing that money. Correct. So till now we have studied that there is a private equity firm which have these general partners. So they will appoint general partners who are again some kind of individuals who have very good kind of expertise, knowledge, who are into this business. They know that which kind of company will work, which kind of company will not work, and they will bring some 2% sort of a investment also in the trust or LLP, which is the SPV, which is incorporated. Balance 98% will come from the limited partners, which are these contributors, and hence they will create this entire pool of funds. Now, there is another person called manager or advisor to the fund. Okay. Now, these general partners are already very busy, right? I mean, they will source the funds, they will create the SPV, they will do the other things, they will do the deal analysis and all. So hence they appoint a manager or advisor to the SPV. Now the role of this manager or advisor is to bring the deals and also help them to evaluate the deals. So these are basically technical experts. These managers or advisors are technical experts. And these general partners are basically more from the entrepreneurship background, right? These would be technical experts because of the experience that they have, but the person who is having the technical expertise is this manager / advisor. So it will, let's say, bring some 10 deals on the table with the general partners, and they will analyze out of those 10 deals. They will finalize, let's say, 3 deals, and they will invest on those 3 deals. Investment 1, 2, and 3. Simple. They have finalized the 3 deals. In all these 3 deals, they will invest, and then they will buy, grow, and sell. So this is the life cycle that we have already seen. This will be completed in, let's say, 5 to 10 years, and they will realize the whatever amount they will get, and using that the returns will backflow to this LPs as well as to GPs, and hence to the private equity firm. Okay, students, I hope this is clear to all of you. This is actually the proper technical term called as venture capital. Now, this entire model is giving funding requirement to the startups. Now, students, if you see, if all of them, now what are the different types of entities involved in this? First of all, there is a private equity firm who is responsible for appointing the general partners. Second is the general partners themselves. Third are these limited partners who are contributing the amount. Fourth entity is this SPV. Fifth entity is this, not entity, but the party to this is manager or slash advisor. Then sixth are all these startups put together. Correct. So you see how many parties are involved in this. Correct. In the entire model to operate. If all these parties, all the above parties in India, this is called as domestic structure. I am coming to the different types of structure. So if all these parties are in India, it is called as a domestic structure. But there is a second type of structure called offshore structure. Now, in case of a offshore structure, the investments, the ultimate investments, which is investments, that is, I'm talking about startup here, correct, is in India. So the investment will happen in India. The ultimate, which is the sixth point I'm saying, the sixth parties are in India. The investment will happen in India. The SPV, which is this trust or LLP, is incorporated outside India. Okay, students. So that is why it is called as offshore, because this SPV is created outside India. This is not in India. This is created outside India, but it will invest within the startups in India. And since it is investing for the startups that are in India, the advisor slash manager is also in India only, who manages and gives due diligence on the project slash deal. Okay, students. So this person who is in India will be managing and will be doing the due diligence, will be doing all the analysis sitting in India only, because ultimately the investment is happening in India. This is called as offshore structure. There is a, so we have studied one domestic structure, and in this is the offshore structure part A. There is another type of offshore structure, which is part B, which is called as unified structure. Now, what will happen in case of a unified structure? So in case of a unified structure, this SPV is still outside India. Okay. But this SPV will not directly invest into our companies, into the India's startups. It will again form a trust in India. So already SPV is a trust itself, but again it will form a new trust in India, and this will be in India. And in this trust, local Indian investors can also invest. Can also invest. Correct. So first, the investment will come from outside through SPV in a trust formed in India, and the local investor, the local Indian investor can also invest. Finally, this entire money will be invested in India. Invested in startups in India. Simple. This is called as unified structure. You're getting my point. So we have covered venture capital model and the venture capital parties that are involved, as well as the structure. There are, as we discussed, one for domestic and two for offshore. One is the offshore itself, and second one is the unified structure. So these are the only technical things in this topic. Rest all, I think, is very easy to understand. But still, let me also finish the next part in startup finance. Okay. Now this is done. Now coming to some, so these are the three modes of financing. One is bootstrapping, second one is the angel investors, and third one is what? The venture capitalists or the venture capital fund, which is the VC fund, one type of the private equity funds. Correct. So now you can go through the life cycle, the different stages, the different, the entire process, and you can relate to what I have discussed in this session. Correct. Now, coming to some of the innovative ways. Now, if the question comes asking for what are the innovative ways to finance a startup. The earlier one we studied, that was the mode of finance for the startup. This is the innovative ways to finance a startup. Correct. Now, first of all, the most innovative or the most popular way is personal financing. Simple. Invest personal savings. Whatever the personal savings are for that particular founder, he or she will invest it into the startup directly. That is called as personal financing. Second, personal credit line. So this personal credit line means that they have a credit card with them. Correct, because that is their own personal credit card, which they will use for the purpose of business. That is called as personal credit line. Then family and friends. The money can be seeded from family and friends. They can invest into the business. That is again a way to finance the startup. Then peer-to-peer lending. Peer-to-peer lending means that, let's say there are 4 different startups. Whenever in need, some of them will give funding to the other. That is called as peer-to-peer lending. Peer-to-peer means at same level. Okay, then crowdfunding. Crowdfunding now crowdfunding means that, student, now there are some platforms. Okay, this would be a new term. So there is a platform. By platform, I mean there is a website. Okay, you simply understand that there is a website which we call as platform. On that website, or let's say on that portal, lot of individual lot of individuals will contribute smaller amounts. Let's say even 100 rupees for that matter. Correct. And that's how the pool again will be created here. And on the portal itself, they will give details on the different startups that are available. Details on different startups. Let's say startup A, B, C, D, E. These all startups will be listed on this platform. And the individuals will go and check that what is that startup doing, what is the profile of that startup, and then they can invest these smaller amounts as well in the startup. This is called as crowdfunding, because the crowd is huge and the amount contributed is less. That is why this is called as a crowdfunding. Okay, students. So this is also actually a startup only. The crowdfunding itself is a startup. A lot of websites, a lot of portals that are running as a crowdfunding platforms are the startup itself. Then the next part is micro loans. Micro loans means the loans for the smaller businesses that are given to the individuals at even a lower rate of interest that can be given. Then the next part is vendor financing. So what happens, students, in vendor financing is that, so basically the the vendor itself will give us the money so that the startup can purchase the goods from vendor itself. So it is again kind of a credit from the vendor. Correct. So this is credit from vendor. The next part is purchase order financing. So let's say we have issued a purchase order, but for executing that purchase order, we need money. Correct. So purchase order financing is means that equivalent to that purchase order. So the purchase order financing companies will advance whatever is the requirement on that purchase order, and hence the PO will be executed. Later on, the amount can be paid to the PO financing company. Then the last part is already factoring that we have already studied. Factoring accounts receivable. Simple. So basically, PO financing is after, let's say we give a PO, against that PO, we also give an advance to carry out the execution of that particular PO. Okay, students. So mostly, students, that's all from the startup finance from my side. Rest all you can please go through, and you can ask if you have any query, because rest all is just a simple thing. Okay, let me discuss certain other aspects as well. The last aspect is the pitch presentation. So basically, for raising these funds, they will have to prepare a pitch. Pitch means a PPT, which will have a lot of detailing. Let's say what is the problem statement that they're targeting, what is the profile of the particular startup, what are they into, what is their team buildup of, correct, and then what is the solution that they're giving, who will be doing the marketing sales, what are the projections that they're having, what is the likely income statement that they have, what is the future projected balance sheet and P&L that they're having, what is the future projected cash flow statement, and what is the exact business model, and what is the competition that they're having, correct, and hence they need what amount of financing requirements. So all these things will be done within this startup. So students, if you see the major things to understand here, and see, since this being a very theoretical topic, there is a need to understand, and there is a need to go through all the things in detail. Correct. So I request that the exact wordings, please go through from the study material itself in detail. The technical part of understanding is what we have already covered. So what we have covered is what is a startup, first of all. That is very important, because there are some 5 conditions that needs to be fulfilled before a company or before an entity can be called as a startup. Second thing, that will help in the overall consistent approach for the government also to incentivize. Correct. Third thing, we have studied what are the different modes of financing. One is bootstrapping, one is the angel investor, and the last part is the venture capital. Venture capital is a technical part where we have to see that what are the different processes and how the model works. Correct. And what are the 3 different structures of a venture capital, one in domestic and 2 in offshores. Then we have studied some of the innovative ways of financing, and then lastly the pitch presentation. Okay, students, now let us go to the second part, which is value at risk. Now all the students, please pay attention. This is a kind of a technical topic. Yeah. So I am going to write a statement. We will take inferences from that statement one by one, and then we will try to understand what is a value at risk. Correct. So students, if you see the general understanding or the general, I mean, what we perceive while we read something called as value at risk. Value at risk means simply that what is the amount of loss that I am going to incur. Simple. Correct. Value at risk means that if I have 100 rupees with me and I invest in some kind of a portfolio, so how much I can expect that 100 rupees will go down. For example, there is a 10 rupees loss that I can incur. That will be given by the value at risk. So what is the maximum amount of loss that can happen to me over a period of time? That will be given by the value at risk. So I'm just giving the proper technical statement and then we will understand it further. So value at risk measures the maximum potential loss. It measures the maximum potential loss in the value of a portfolio over a given period of time for a certain confidence level. I will make you understand the meaning of each and every term in this value at risk, and then we will cover 4 questions also to make our understanding better. Yes, students. So we are saying that value at risk. First of all, you imagine that value at risk is some kind of a model. Okay. Now, if you remember in derivatives, we have studied Black-Scholes model. Correct. Black-Scholes model will give you an output. What kind of output? It will give you the value. It will give you the price of an option. Correct. What is the premium of an option? That will be given by the Black-Scholes model. And it will take some inputs, some set of inputs. It will apply that formula. And then finally, it will give us that what is the premium value. Similarly, value at risk is also a model. Okay, is also a model, is a framework which will give us what? Which will give us that what is the maximum potential loss? What is the maximum potential loss? Okay, so this is the output. Value at risk. So I'm talking about this is a model. This is a, let's say, mathematical model which will give you a output of maximum potential loss. This is the output. Correct, students? So it will give you the output or as what is going to be the maximum potential loss and what all inputs it will ask you. It will ask you that, okay, this is the maximum potential loss I'm going to have. So the input that it is going to ask you. Just a second. Yeah. And what are the inputs that it is going to ask you? One is that what is the level of confidence? This is A. I will explain these things. Number B is the standard deviation of returns of portfolio. value of the portfolio time horizon slash time period, whatever it is. Now, what types of input it will take? It will take what is the level of confidence, what is the standard deviation of returns, what is the value of that portfolio, and what is the time period. All these 4 5 things it will take into the mathematical model, and then it will throw a maximum potential loss as output. Now, let me again, okay, as of now, I have not even explained what are these terms, but again, I'm just taking an example, and then we will again come back to this to this definition. Okay. Now, students, level of confidence is, let's say, 95%. For example, now what does this mean? If we say that level of confidence is 95%, that means that ultimately whatever we are doing, that has a 95% chance, that has a 95% probability. Confidence means that we are confident that 95%, and how much we are confident is 95%, which is called as the level of confidence. So for example, if I have to calculate a probability that I will reach from, let's say, we can say from Delhi to Mumbai, for example, probability to reach Mumbai from Delhi within 2 hours is actually 95%, for example. So this will mean that level of confidence is 95%, correct? So that means we are confident to the extent of 95% that in 2 hours we will reach from Delhi to Mumbai. That is called as level of confidence, correct? So level of confidence means that probability percentage of that thing to happen, of that particular thing to happen, correct? I hope I'm clear. So level of confidence means 95%. I am confident that I will reach to Mumbai from Delhi in 2 hours. Correct. That is called as level of confidence. Level of significance is actually 5%, which is 100 minus level of confidence. Correct. So basically, what does this level of significance means? Probability to reach Mumbai from Delhi beyond 2 hours is 5%. Can I say that if I say that there is a 95% chance that I will reach within 2 hours? So can I say that there is a 5% chance that I will reach after 2 hours? That means beyond 2 hours. Both the statements are same only, right? But it's just a different way of it's just a different way of presentation. I am saying that within, I have a confidence of 95% that I will reach from Delhi to Mumbai within 2 hours. Can I say that I have a 5% chance that I will reach from Delhi to Mumbai in more than 2 hours? You're getting my point? So this is what is called as the level of significance. Level of significance is the exact opposite of the level of confidence. Correct? Now let me take another example. Let me relate now to the topic that we are studying. I hope the confidence level and significance level is understood to all of you. Students, again, I'm asking, please ask any questions if you have on this, okay? Confidence level is, let's say, 95%. Significance level is, let's say, 5%, which is nothing but 100% minus confidence level. Correct? We can calculate this. Time period. We are talking about 1 day actually in this case. Okay. We are talking about only 1 day. We have a portfolio value of around, let's say, 20 lakhs. Rupees 20 lakhs. This is the portfolio value that we have. Okay. Now, SD is also given to us, but I'm not putting that value because that value as of now we will not use in our understanding, because I'm just wanting to create the understanding here. Correct. Now, if we arrive at using VAR, if we arrive, let's say 20,000 is the maximum loss that is coming. Correct. This is coming as an output. We put all these things into this model, and we arrive at the maximum potential loss of rupees 20,000. So what does this first of all means? This means that within 1 day, there are 95% chances that the maximum loss will be 20,000. Very easy, very simple. Within 1 day, the maximum loss is 20,000. That can happen. Correct. The maximum loss is 20,000. The probability of this, is 95%. We are only 95% sure that the maximum loss will be 20,000 in a single day on this kind of a portfolio where you are having an initial investment of 20 lakhs. Okay. So we are saying that the maximum loss is 20,000. So it can be anything, let's say 18,000, 19,000, 19,500, or even 20,000. It can be maximum up to 20,000, and the percentage chance or the percentage surety for that is 95%. Now, students, just see how I am turning the statement here. This is the first part of the statement. The second part, I can also say that within 1 day, the minimum loss is rupees 20,000. The probability of this is 5%. This is considering the level of significance in mind. This is considering the level of confidence in mind. The first part is considering the level of confidence. The second part is considering the level of significance. So if we say that there is a level of significance which says that there is a 5% chance that your loss will be higher than 20,000. Simple. That means the minimum loss is 20,000. There is a 5% chance for that. So in 5% cases, your loss will be more than 20,000. And in 95% of the cases, your loss will be maximum 20,000 in a particular day. This is called as value at risk. To analyze this statement, to arrive at this 20,000 rupees, is this entire model is called as value at risk. So can you say that how much is the value at risk? the value at risk is 20,000 at a level of confidence at 95%. So this is always expressed at a certain level of confidence. Now, it can be, let's say, 98% and 2% also. It can be 99% and 1% also. It can be 90% and 10% also. It can be anything. At a if you change this, the loss will also change, correct? At 95%, it's 20,000. Let's say at 98%, it will be higher or lesser. Whatever it is, we will see how to calculate that. Correct. But what I'm trying to say is that at a certain level of confidence, what is the maximum loss that can happen to a portfolio value over a period of time? The period of time we have taken here as 1 day. It can be 10 days also. It can be 30 days as well. It can be 1 day as well. Sorry. Okay, students, I hope the value at risk concept is clear per se. Now, let me go to the second part. Students, we always say that the returns from security, are normally distributed. For example, if we put the returns in this chart, we will get a bell curve shape like this. This is a normal distribution table. Please refer my discussion while we were studying the Black-Scholes model in our derivatives, where I explained what is a normal distribution table. We studied that there is a Z score that needs to be calculated. We need to calculate Z score, right? What is that Z score? Z is equal to X minus mean divided by standard deviation. We said that normal distribution, this is an area under curve. Area under curve represents the probability, right? I'm just taking it a bit faster because we have already discussed this. And in that, we used to calculate the Z score. Then we used to refer the normal distribution table. And for this Z score, we used to calculate the probability there. Okay, let me just show you. This was the normal distribution table, correct? You remember we studied that area from the left to the Z score is this. And these were the values that are there, correct? These are the values that are there, the different probabilities. So these are the probabilities value at a Z score of minus 3.9. So that is how it used to be, right? So it gives us a relationship between the Z score and the probability, the area under normal curve. In this case, we are given the probability, right? We have been given the probability. What is the probability? Level of confidence. Let's say it is 95%. Then what is the Z score going to be? So in this, we have to calculate the reverse. In this, we are given the probability and we have to take the Z score. Simple. Correct? And then the formula for VAR is Z score multiplied by standard deviation. This we have to put for the relevant time horizon. Okay, this is called as value at risk, in which we have to put the Z score and the standard deviation. So Z score will come from the level of confidence, whatever it is. It will be seen from the table and put in here. And the standard deviation will always come in absolute. Students, now please note, this is a very important point. This will be coming in this, okay, always absolute. Always put absolute, not in percentage. We will see through the questions how. Z score using table, take probability and find Z score. Simple. Relevant time horizon means given in question. It can be 1 day, or it can be 10 days, or it can be any number of days. For that only we have to take the standard deviation. This is called as var. Simple. Now, let us derive some other useful things. So students, if you see, variance for a particular time period would be equal to variance of 1 day, correct, multiplied by the t. So this is actually 1 day absolute amount. T is equal to the number of days. Now, for example, okay, we will just specify this and then we will go to the example. So let's say the time period is 10 days. We have to calculate the variance for 10 days. For that, we will take the variance for 1 day and multiply with 10 here. Correct. This is variance for 1 day. So 10, if you multiply it with 10 for variance for 1 day, we will get the 10 days variance. Now to get the standard deviation for time period, can we say square root of variance of 1 day multiplied by t, correct? I've just taken the square to square root in the seconds in the right hand side. So standard deviation for time period is equal to standard deviation of 1 day multiplied by under root t. Simple. This is a very important conclusion which all of us have to remember. So to calculate the standard deviation for 10 days, for example, we will have to take the standard deviation of 1 day and multiply it with the under root of t. Under root of t, which is 10 days. Under root of 10 days. Okay. And similarly, var for t days will be equal to z score multiplied by standard deviation for 1 day multiplied by under root t. I hope this is also understood. Correct, because we have studied that normal var is what? Standard deviation of relevant time period. So if we have broken down the standard deviation of relevant time period into this standard deviation of 1 day multiplied by under root of t, which we have put in here. Simple. Again, I am specifying this standard deviation will always come as absolute. And there is a last relationship also that we can put, where for t days is equal to where for 1 day multiplied by under root t. Simple. Because if you see this till here is actually var for 1 day, correct? Z score multiplied by standard deviation for 1 day is the value at risk for 1 day. So we can, if we are given value at risk for 1 day, we can just simply multiply with the under root t to arrive at var for t days. Simple. Let me again bring the conceptual clarity. So value at risk, students, we studied that it is one kind of a mathematical model Okay, quantitative finance, which will give you some kind of a maximum potential loss at a certain level of confidence by using standard deviation of returns, value of portfolio, and time horizon. Simple. What is the time period? We studied that what do we mean by level of confidence. Level of confidence is just simply the probability of maximum loss happening. So we studied that probability of maximum loss that can happen up to 20,000 is 95% within one day, which is the example we have studied. And the reverse of this will be the probability is 5% that the minimum loss is 20,000 in one day. Correct? That is called as the level of significance. We also studied that since the returns from the securities are normally distributed, we make use of Z score. So Z score will be derived from the normal distribution table. In the Black-Scholes model, using Z score, we used to find the probability. But in this, we already have been given the probability. Using probability, we will find the Z score. And that Z score will be used in the calculation of VAR. This standard deviation, we said that always it will come in an absolute amount, not in percentage. What is the absolute amount of standard deviation for the relevant time horizon? And we also studied that to convert the standard deviation of the relevant time period, we can take 1 day standard deviation and multiply it with the underscore under root t. And for var for t days will be the z score sd 1 day and underscore t. And similarly for var t days will be var for 1 day and under root t. Okay. These are the formulas that we have studied. Okay. So let us go to the questions now. Before that, okay, there are some queries. Let me take the queries first. Namita is asking, please explain 4 bulleted points on first point on page 14.10. I hope you're asking from startup finance. Yeah, I hope Namita you're asking this deal origination, right? Which is the sector focus, stage of business focus, promoter focus, and turnover focus. I hope these are the points that you're asking. So if you see, Namita, this is basically the VC investment process. Correct? 14.10 page number for all the other students if they want to refer on the study material. So they say that what is the VC investment process? The first part in the VC investment process is definitely the deal origination. Correct? As we have studied that there is a management or advisor to the fund. Where is he? In this we studied, right? There is a manager or advisor to the fund. Correct? So he will be acting as an intermediary and he will basically get the deal. He will identify the deal. He will get the deal originated. And before the deal it is sourced, so he basically the VC, the venture capitalist, correct, would inform this manager / advisor not to search any kind of deal, but to stick to certain requirements, correct, so that at last the efforts is not wasted, correct, and the time is not gone. So he will say that I have a sector focus. I want the startup to be there in the particular sector. Sector means there are different sectors, right? Automobile sector, FMCG sector, or let's say in a services sector, food services sector, any kind of sectoral focus that venture capitalist might have. He will tell this to the manager or to the advisor that you always look for the startup in this particular sector. Okay, don't go in any sector because that will just waste our time. Number one. Number two, stages of business focus. So at what stage the business is. For example, if it is in the smaller stage, it is just started. So some venture capitalists would be interested in that, or some venture capitalists would be interested in the medium level business, right, which has started, let's say 2-3 years back, and now it is already at certain kind of operating level. From there they want to take it to the next level. So that is a stage of business focus. Third is the promoter focus. Promoter focus means who are the founders, correct. I mean, what background do they have? Are they professionals, or are they coming from the business families, or what kind of focus the promoter wants to have, or even what kind of profile that promoter have. Then the turnover focus. So the turnover focus means what kind of growth that they look into, correct, what is the right volume growth and the price growth that they're looking into, correct. So those all things will come into the turnover focus. So basically these 4 things, specifically the general partners itself, or the venture capitalist itself will specify to the manager slash advisor that you go ahead and find the deals around these four focuses only. Okay, Namita, I hope I'm clear. Sairam is asking, sir, in exam, Z score value is given or not? Definitely, Sairam. Either it will be given in the question or you will be given a direction how to calculate the Z score in examination. We will solve the questions. We will see how we can find it. Now, I think the where is clear. Now let's go to the question number 1. Yes, all set. The where on a portfolio using 1-day time horizon. Okay, one more thing I forgot to tell all of you is, see what are the use of VAR, value at risk. Sorry. Students, if you see a lot of companies today are doing the risk management, correct? Let's say there is a company who is into the business of creating the portfolios. They are the asset management companies. They need to know that how it is going to phase it out. I'm just taking one more minute before we jump to the question. See, the conceptual understanding is done till now. I'm just giving you something practical, why and where it is used. Okay. So now if you see VAR, it is generally, let's say, if you talk about a company who has created a portfolio. Okay. I'm giving you a practical example. Now, while creating this portfolio, they need to know that over next 20 days, okay, the time period is, let's say, 20 days. The level of confidence is 95%, correct? And the portfolio value is 10 lakhs. Hence, the maximum loss using VAR. And the standard deviation is also given something, correct? Using that, we have calculated the maximum loss using VAR. It comes out to, let's say, 5,000 rupees. Now, this information is given from VAR that 5,000 rupees is the maximum loss that you can incur in the next 20 days. And the probability of that is 95%, correct? For having the maximum loss of 5,000. Now, how does this company uses this information? Now, what does this company will do is, okay, I have this. Now, can I also say that out of 20 days, in 1 day, can I expect 1 day expected loss to be 5,000 maximum? How I have calculated 1 day? I have taken 20 days and multiplied 95. So basically 100% minus, sorry, this is minimum. So 100% minus 95%. So I have multiplied it with the level of significance. This statement I have just changed. So out of 20 days, in 1 day, expected loss to be 5,000 or more. This is the right term to put. So that means the minimum loss is 5,000 because we are using level of significance. So in this 20 days, 1 day, our loss will be more than 5,000. Balance 19 days, our loss will be maximum 5,000. Loss is maximum 5,000. 1 day. Loss is minimum 5,000. Can you see now the information of this 5,000 from level of significance and level of confidence has changed to what is the number of day looking like? It is going to be like this. So, and now the information can be used by them to plan their investments better, to plan for their portfolio better. Okay, students. So this is another way of looking at it. Now coming here, Namita is asking, sir, where is equal to Z score into SD? Please explain what does this formula says. So that's what, Namita, I have just now told you, that this will give us the maximum loss. In our example, what we have seen is, see, this was our example, right? So this is the resultant of that formula. Maximum loss will be coming as 20,000. And that var is basically meaning this: within one day, the maximum loss is 20,000 with a given level of confidence at 95%. Or the chance of maximum loss happening at 20,000 in one day is only 95%. That is called as var, simple. Okay. So the Z score multiplied by SD is giving you this 20,000 rupees value. That is var. Okay. And the meaning already we discussed. Now let's see the questions so that all of your understanding will be stronger. So var on a portfolio using a 1 day time horizon is 100 crore. What is the var using a 10-day horizon? Simple. So they are saying var for 1 day is equal to 100 crores. And var for 10 days will be how much? Now you see, students, 100 crore is a very big amount. That means the value, the maximum loss that portfolio is exposed to is 100 crore. You can imagine the value of that portfolio, how big it will be. Correct. But anyway, that is not the part of our question. So we know that, first of all, var for 10 days is equal to var for 1 day under root 10. Correct? This is coming from this formula. This formula it is coming. Var for t days is equal to var for 1 day multiplied by under root t. So this comes as 100, which is the var for 1 day under root 10, which is equal to 316.22 crores. So var for 10 days is equal to 316.22 crores. Simple. So what does this mean? Now, for a 10-day period horizon, the maximum loss that can happen to the portfolio is 316 crore. In 1 day, the maximum loss that can happen is 100 crore. Simple. In this, the level of confidence and significance is not given, hence I'm not using that anywhere, and that's not even required as well. Okay, students. Coming to the second question. Okay, all of you please note it down. Then I will go to the next question. Very simple, very easy, just a one-liner question. Yeah, now let's go to question number second. If the daily var is 1,25,000, students, please note these questions are already uploaded in the assignment section. Please go from there and check it if you are not having a copy of it. If the daily var is 1,25,000, calculate the weekly, monthly, semi-annually, annual var, assume 250 days and 50 weeks per year. Simple. So they are saying that var for 1 day is given, you have to calculate weekly, monthly, semi-annually. So first of all, we will calculate the weekly var, correct? Now there are 250 days and 50 weeks in a year. So that means 5 days per week we can use, correct? Because we are saying in a year, there are 250 days and 50 weeks. That means how many days per year? How many days per week? It's 5 days, okay? So it comes as 1,25,000 multiplied by under root 5 for 5 days. So this is coming as 279,509. Then comes monthly. Monthly will be 1,25,000 multiplied by under root of 250 divided by 12. There are 12 months in a year. 250 is the total number of days, and we will take divide by 12. We are just taking the assumption that is given in the question. Correct. We are not taking 30 days. We are not taking 31 days. We are just simply taking 250 divided by 12. So this comes as how much? 11,88,634. This is the monthly VAR. Now the semi-annual VAR. One lakh 25,000 multiplied by 250 divided by 2. Correct? 250 for full year. Semi-annually will be divided by 2. So this will give us 1397 542.50. Students, please note, don't think that we can just multiply the monthly VAR by 6 and arrive at the semi-annual VAR. No, that's not the right approach. Why? Because it's not directly proportional to time. It's a under root of time. Correct? We have studied the derivation as well. So using that only we are saying, because the variance has to be multiplied with the number of days to arrive at the standard deviation, not the standard deviation itself. Okay. Then the annual VAR. Will be 1,25,000 under root 250. This is equal to 1976,423.5. Simple. So Namita is saying, sir, an example, why our maximum loss is 20,000 in stock market, we can lose entire 20 lakhs. Okay, Namita, I'll tell you. I got your query. Just give me 1 minute. Let this question happen. I will explain in detail. Second query from Namita is, please solve question 1 in which we need to calculate VAR. Namita, I've already solved that question number 1 because that was relatively very simple. Question number 3 and 4, we will calculate the VAR. You will see that the VAR calculation, evaluator's calculation later. All of you please note it down. Then let me take the first query. Okay, shall we move? See, now Namita is asking a very good question actually, which will be there in all of your mind. See, let me just take this example again. Correct? This is the starting point. Now, we said that confidence level is 95%. Okay. Portfolio value is 20 lakhs. And there is some SD. I mean, I'm not taking SD here. There will be some SD that is already given. Using that, we arrived that there is a maximum loss of 20,000. Now, Namita is saying that in stock market, there can be a situation where we can lose entire 20 lakhs. I am also saying yes. Namita, I am also saying yes. How? See, I am using this statement to tell you the same thing, which you are also saying. What I'm saying is that there is a 5% chance that your loss will be minimum 20,000, and it can be up to the upward, it can be even 20 lakhs. We're getting my point. We are just playing with the words here, Namita. We are saying that there is a 5% chance that your minimum loss is 20,000 and maximum it can be anything. I mean, on the upper side, it can be anything. If I have to explain this, see, where, which is 20,000, this is the maximum loss. Once we talk about the confidence level, correct? So this 20,000 will become minimum loss. If we talk about significance level, correct? Because if there is a 95% chance that maximum loss is 20,000, then there is a 5% chance that the loss will be minimum to 20,000. If the loss is minimum to 20,000, so let's say this is 0, this is 20,000, and this is the 20 lakhs. This is the value of portfolio. This is the value of, this is the VAR basically, and this is the 0. So now what I'm trying to say is, there is a 95% chance that your loss will be from 0 to 20,000. But there is a 5% chance that your loss will be from 20,000 to 20 lakhs. Okay, Namita. So we are also saying the same thing. Even the VAR is also saying the same thing, but in a professional manner, assigning probabilities to it. Okay. So yes, stock market, you can lose entire 20 lakhs. There is a 5% probability that your loss will be higher than 20,000. We don't know whether it will be 40,000, 1 lakh, 2 lakh, 3 lakh, or entire 20 lakh. But there is a chance of 5% that it will be more than 20,000. Okay, students. No, Namita, it's not, in reality, it's not 50-50. So Namita is now saying that we have taken only 5% chance that it will be more than 20,000. But in reality, she's saying that it will be 50-50. No, see, that's not the case. Now the reality has to be seen from the past, correct? See, from the past, you know that what is the standard deviation, correct? From the past returns, you calculate standard deviation, and that standard deviation you project for the future. You multiply it with the value of portfolio and you multiply it with the probability Z score. And hence you try to project for the future using the past standard deviation. If the past standard deviation says that it is 100%, then I can understand there is a 50-50 chance. Standard deviation 100% means there is a 100% downfall or a 100% up that is possible in the value of portfolio. But if the standard deviation is only 2% or 3%, I cannot say that there is a 50-50% chance that the entire value will go down. You're getting my point? Again, go back to the portfolio discussion that I had, in which I told that standard deviation will tell you that what is the possible deviation from the possible deviation of the actual return from the expected return. If it is 100%, that means your entire value can be doubled or your entire value can be 0. Correct? But if it is only 2 or 3%, that means the impact will be rotating only within the brackets of -2 and +2. Okay, you remember that we calculated a range in SD, right? So hence, it's not a 50-50 ratio. We know that history has been that standard deviation is only 2 or 3%, and hence the future projection is. Now coming to the third question. Neil holds ₹1 crore shares of XY Limited. Whose market price standard deviation is 2% per day. They have already given for 1 day. So there is nothing to worry. 2% per day on 1 crore turns out to be 2 lakhs, correct? Simple. So I'm saying that always standard deviation use in absolute amount, not in percentage for VAR. So hence I've right away converted the percentage into absolute by multiplying it with the portfolio value. Assuming 252 days trading in a year, determine the maximum loss level over a period of 1 trading day. So time horizon is 1 day. Maximum loss they are asking, that means level of confidence is required. Because level of confidence will give you the maximum loss. Level of significance will give you the minimum loss, correct? For 1 day and 10 days. So T is equal to 1 and 10 days. We are given 2 scenarios. T is equal to 1 and 10 with 99% confidence level. If there is a 99% confidence level, what is T is equal to 1 day and T is equal to 10 days VAR? Assuming share prices are normally for the level of 95%, 99%, the equivalent Z score is 2.33. So they have given you the Z score as well. They have given you the probability 99%, which is the level of confidence. Since we are talking about the maximum loss, hence we have to see the level of confidence. Probability 99%, Z score 2.33. Even if they have not given this, students, if you see, I hope the screen is visible. I'm just making it a bit larger so that we focus on that figure. Okay, this is the standard normal loss table. Sorry, not normal loss, standard normal distribution table. Okay. Now, if you see what probability we have, 99%, can we write it as 0.99? Yes, 0.99, correct. So that 0.99, let us search where it is. See, exactly it is turning here. That 0.99 is turning between this value and this value. So let us see what is this value actually. 2.3, correct? And on top, it is 0.03. So 2.3 plus 0.03 will give us somewhere around 0.99. Hence, 2.3 plus 0.03, which is actually 2.33. The same thing is given you in the question as well. The Z score of 99% probability is 2.33. Okay, students. I hope this is clear, right? Now we have to just apply this. Finally, what is the question asking us? See, what is the model? Model is we are talking about var. T is equal to 1 and 10 days. Two scenarios the question is asking us. One is for 1 day and one is for 10 days. Level of confidence 99%. This is the second input. SD 2%, or I can write 2 lakhs, correct? Z score using this level of confidence 2.33. Can we calculate the maximum loss? Yes. Let's use the formula and calculate. So SD for 1 day is equal to 1 crore multiplied by 2%. Simple. It comes as 2 lakhs, correct? That is what we have already calculated. SD for 10 days will be 2 lakhs under root 10. Correct? SD for 10 days will be SD for 1 day multiplied by under root of T, which is this. So it comes as 6.32 lakhs. Now, using this maximum, we will use the same sentence that the question has used. Maximum loss for 1 day at 99% confidence level. 2.33 is the Z score value, correct? Multiplied by the SD for 1 day is equal to 4.66 lakhs. Maximum loss for 10 days at 99% confidence level. 2.33 into 6.32 lakhs, which is equal to 14.72 lakhs. Simple. Simple. Okay. So the solution is very simple. We have just calculated the maximum loss for 1 day and maximum loss for 10 days. And for calculating the maximum loss for 10 days, we have used the standard deviation for 10 days, not for 1 day. Z score remains same, which is again at a level of confidence. Okay, students. After this, we will do our last question of the session and of the topic as well. Yes, Namita. So Namita is asking, sir, in 10 lakh portfolio example, yes, why we say that 5,000 minimum loss for 1 day as wire is for 20 days. Okay, great. So actually now, Namita, if you see, I have represented in a separate manner. Okay, let me go to that particular example only. Yeah, this one, right? Yeah, this one. So we said that portfolio value is 10 lakhs. Okay, let it come. Yeah. We said that portfolio value is 10 lakhs. Maximum loss is 5,000 for a time horizon of 20 days. Correct. So there are two ways to interpret it. I'm not talking about the from the level of significance and confidence. I'm talking about level of confidence itself. There are two ways. One is that within the next 20 days, the maximum loss that can happen to us is 5,000, and the chance of that, the probability of that is 95%. Simple. That is the normal way that all of us will agree, correct? But i'm just it I'm just modifying the sentence to say that out of 20 days, 19 days is where the loss is maximum 5,000, because what I have done, I have multiplied 20 by 95%, which is 19, to arrive at that how many days there is a maximum loss of 5,000, and how many days out of that day will be the minimum loss. You're getting my point? So still the where is for 20 days. I'm not debating that. Where is still for 20 days. Okay, Namita. If you say the way I have told in statement 1 or statement 2, both the statements, where is for 20 days. But it's just a different way of seeing the where. Because in the first way, you are saying that 95% chance that loss is maximum 5,000 in 20 days. I am saying 19 days maximum loss will be 5,000. Simple. That's all. That is the only change. Correct. This is statement 1 and statement 2. Similarly, for the level of significance also, you can see 5% chance that loss is minimum 5,000 in 20 days. That means 1 day minimum loss is 5,000. Simple. Okay, now let me go to the last question. So the last question says that consider a portfolio consisting of rupees 20 crore. No, it's 2 crore, right? Yeah, it's 2 crore investment in XYZ and a 2 crore investment in ABC. The daily standard deviation of both the shares is 1%, and the coefficient of correlation between them is 0.3. What is this coefficient of correlation? This we have already studied in portfolio management. You're required to determine the 10-day 99% value at risk for the portfolio. Simple. First of all, we need to understand that what is the standard deviation of portfolio. This we need to calculate. This will be calculated on 10 days horizon. Simple. Correct. So the standard deviation of portfolio from the portfolio management subject, from the portfolio management topic, we know that the variance is equal to weight of A, weight of B square, variance of B square plus 2 weight of A, weight of B, standard deviation A, standard deviation B, correlation coefficient of A and B. This we have already studied, discussed, explained in the portfolio management. Correct. So I've just copied the formula here. Now we know that what are the weights, 0.5 and 0.5, right? Because the investment is equal in XYZ and ABC. So 50-50% is the weight. Can we calculate the portfolio variance? Yes. 0.5, 0.01. I'm taking 0.01 because 1% is the standard deviation, correct, for the respective share. Plus 0.5 square, 0.01 square, plus 2 into 0.5 into 0.5 multiplied by 0.01 0.01, and the correlation coefficient is given as 0.3. Students, this is the same, exactly the same thing that I have done, that we used to do in our portfolio management. If we solve this, the portfolio standard deviation comes out to be 0.8062 percentage. Now, please note that this is all for 1 day, because in the question, this 1% is given for 1 day, the daily standard deviation, correct? The daily standard deviation for 1 day. Simple. So this we have calculated. So SD for 1 day. What is the total portfolio size? We have to calculate in absolute, right? As I told you that in VAR formula, we always put the SD in absolute. So this will be 400 lakhs multiplied by 0.8062 percentage, which comes as 3.22 lakhs. Similarly, SD for 10 days, 3.22 multiplied by under root of 10. Simple, correct? Which is under root T, that we have already studied in the formula. Rupees 10.18 lakhs is the standard deviation for 10 days. Okay. Now, what is the level of confidence? Is 99%, correct? As per our standard normal table. So again, the 99% comes as 2.33, right? 2.3 for this, and 0.3 we will have to add for the above, correct? So it comes as 2.33. So we will use the same number here. So hence the VAR for 10 days is equal to 10.18 lakhs multiplied by 2.33, which is equal to rupees 23.72 lakhs. Simple. This is the VAR for 10 days. So students, with this, we have completed the startup finance as well as the VAR topic from my end.